Our first question comes from Tim. I have heard some analysts on Motley Fool podcast discuss companies' non-GAAP numbers, GAAP numbers, and often followed with a chuckle, a knowing
like
inside
this?
joke. Non-GAAP numbers. Come on.
Silliness.
My question is, why is non-GAAP useful in evaluating a business? If their numbers are not in line with GAAP, what can be learned from those statistics? And if I remember right, GAAP is general something accounting principles?
Yes, generally accepted
accounting
principles. Here we go. Ready? This is going to get a little weedy, but I'll try to make it fun.
Not the cannabis.
In
the weeds. So companies must follow GAAP accounting. By law. I don't know if law is the right word. By regulation.
By accounting law.
But sometimes both companies and analysts want to make adjustments and look at things a little bit differently. Often that's because a company will have a one-time charge that doesn't recur, a non-recurring event, a non-recurring charge. So the company will want to point that out to investors, and analysts will want to do a little digging of their own and start to make adjustments.
Could that example be like a lawsuit payout?
Absolutely.
Or what are some other examples of a one-time charge?
Something weather-related.
Oh, yeah, blaming the weather is good.
Well, but I meant like, like if there's a manufacturing facility that has to close down for a few days because it was a hurricane or even layoffs that have never happened before, you wouldn't want to necessarily project those into the future. So we want to make adjustments. But when a company does that, they're in violation of GAAP. So they have to point out that they're introducing non-GAAP numbers to the world. And they really have to make that very clear. And it's supposed to be helpful to investors. The one caveat I would say is, if these adjustments are being made because of what we just said, one-time events, non-recurring events, let's all be very sure that we buy into the fact that they're non-recurring. And restructuring charges are kind of a notorious thing here. There are many companies that somehow seem to have a restructuring in some form every single year, but yet they count them as non-recurring. A good analyst, a good investor will recognize that that's a little bit, they're playing some shenanigans here. And let's actually count that as a recurring expense and not give the company credit for this one-time event. So you got to be careful, but they can be very helpful. We as analysts adjust income statements all the time for things that aren't really kosher from a GAAP accounting perspective, because accounting rules can be kind of wonky, and sometimes they don't reflect reality, especially things like depreciation and amortization, which are non-cash expenses. People play around with those, make adjustments for those. So non-GAAP is actually quite helpful.
How much of your time as an analyst and an investor do you spend looking at these numbers, GAAP or non-GAAP or otherwise, versus anecdotally kind of looking into the company and thinking about their future?
I would say most of the time should be looking at the qualitative, the words. What does the company do? How does it make money? Who's the management team? Does the company have a competitive advantage? Who are the competitors? What's their market share like? All those things that really help you understand a business. And then maybe 25%, just making that up, is digging into the numbers. What do the growth trends look like? Is revenue trending upwards, or are they profitable? What do their margins look like? And then we can kind of use all that information to maybe get a gauge of whether we think the stock price is fair, cheap, or expensive at any given time. But most of the time, especially for just non-analysts, everyday investors, I think you want to spend most of the time to try to understand the business.